Hello everyone, I'm Paul Orfanos, the National Community Engagement Manager at Delphi Bank, which is a division of the Bendigo Adelaide Bank, and welcome to our annual community economic presentation conducted in association with our friends at the Greek Community of Melbourne. Now at Delphi Bank, and as our group, the Bendigo Adelaide Group, we're certainly very proud that besides being a profitable and professional bank, we've also positioned ourselves in the marketplace as an organisation with a social conscience. And we're certainly very proud of that. And people that know us can see what we do every month, every day, and every year with regards to our social commitment and community commitment out there. One particular commitment and initiative that we've recently launched that I'm very proud to let you know today is a national petition for the return of the Parthenon marbles that we've recently launched, and links to that petition can be found on our website at delphibank.com.au. Now, today's presentation, titled The Post-Pandemic Economic Recovery Amidst Geopolitical Turmoil, is certainly very topical. The global pandemic, I don't need to tell you, but has disrupted all economies and societies around the world, including bringing to an end a record-breaking 29 years of Australian economic growth that I thought would never end, actually. In this presentation, our speaker, David Robertson, will be posing the question, where to from here? And it's a question that a lot of us ask, where to from here? As our economy reopens, whilst dealing with living with a virus on the one hand and geopolitical and trade tensions. Now, David is an esteemed colleague who joined the Bendigo Bank 19 years ago as the head of financial markets, and today is the head of our economic and market research area. His banking career commenced in 1989 as a foreign exchange dealer, and prior to joining Bendigo, he worked in a range of senior positions in Treasury for the State Bank of New South Wales, the First Chicago Bank, and also the Commonwealth Bank. David's regular commentaries and videos, which actually I highly recommend. It's a great 3 or 4 minute summary of what's happening in the world of markets and economics that comes out monthly, can be seen on the bank's website, YouTube platforms and LinkedIn platforms. And beyond the world of banking and his family, David's passion include golf, the outdoors and thoroughbred racing. So without further ado, David Robertson, over to you, David.
Well, thanks very much for that introduction, Paul, and good evening. It's a real pleasure to be with you again for the next in this series of updates. I think this is about the fourth or fifth in the series, and sadly joining you virtually again this year like last year, but I'm sure next year we'll be able to catch up face to face for a traditional live event. But it is a real pleasure to be with you all, and thanks very much for taking the time out of your busy schedules to join us this evening. There is so much to cover on the economic landscape and really the impact of the pandemic on the outlook for the economy, for the markets, and for society more broadly. So I'll dive straight into it in the interest of time and share my screen. Paul, you can let me know if there are any issues with that, but hopefully the screen is evident now.
All okay, all okay.
Okay, so the slides are there, that's great. And look, at some, as per previous years, I'm sharing the information or our forecasts about the year ahead, and it might surprise you that actually what I'm sharing is a fairly optimistic set of forecasts, and that might surprise you given all of the stress and strain of the last couple of years. But really the sharp rebound from the recession of last year is evidence of the resilience of our economy, and I think should give us confidence about the recovery that we will see from the double dip, the Delta strain of this year. So again, assuming the slides are clear on the screen there, I'll continue to tab my way through them, and I'll do so at a fairly brisk rate to make sure there's plenty of time for Q&A at the end. But well, for those of you who are located in Melbourne, and that's I think the majority of those participating this evening, it's really been I suppose not just the financial trauma of going through a recession to deal with, but also the health trauma, the physical and mental health of being in a pandemic. And somehow Melbourne along the way managed to win the crown of not just Australia's most lockdown city, but the world's most lockdown city. So the streets of the CBD have definitely been deserted until recently, but great to see everything reopening and reopening really quickly. And judging by this photograph of St Kilda from Melbourne Cup Day, people have been demasking and are definitely ready for summer. So there is a hint of optimism around the economic recovery here and around Australia. And I'll cover, first of all, the global outlook before I come back to the outlook for Australia, and then more specifically for Victoria and Melbourne. But before I dive into the predictions, I just want to highlight the main themes and the three main takeaways from the discussion this evening. And the first is that I do expect demand to really rebound very quickly. So it should be an immediate recovery now that the restrictions have been lifted, and the V-shaped recovery we saw last financial year again showed us how well the pandemic was managed initially in terms of the success of the lockdowns and enabling reopening, with the exception of Melbourne in some respects last year. But now, if you translate that to where we need to go from here, it's all about vaccination rates to keep hitting those, to keep that recovery on track. But you know, demand seems very likely to be very strong both through to year end and through 2022. I think the challenge may be supply, keeping up with that demand. And we've certainly seen instances of not just freight delays, but freight costs are through the roof. A lot of challenges around accessing imported goods, accessing parts and materials, and elevated costs with them. So that's one thing we'll need to explore. Secondly, we've had a very welcome alignment of fiscal policy and monetary policy, and really they should always be aligned. But one of the reasons the recovery was so strong last financial year is because of the degree of fiscal support and monetary support hand in hand with it. As it happens, I think the chap on the left there, who's responsible for monetary policy, will be a little more generous over 2022 than on the right, with the Treasurer presiding over fiscal policy. So as fiscal policy is pared back, I think we need to ask the question, how well equipped are businesses to cope with fiscal policy tapering off? But equally for central banks, you know, we're seeing central banks all around the world singing from the same hymn sheet. It's really been the same messaging that, yes, there's a rise in inflation, but it'll only be temporary. So I think it's going to be a real challenge for central banks, both here in Europe, in the US and elsewhere, to walk that fine line between enough inflation and not having too much, really to get that Goldilocks growth trajectory and Goldilocks in terms of inflationary pressures as well. And I have to say the central banks, I think what they've achieved over the last year with ultra low interest rates has probably been more of an impact on that property market than on the economy and for businesses, who have more so been supported by fiscal policy than monetary policy. So they're the main themes, and I'll use them to build up to 10 predictions for the year ahead. Before I dive into that, I better just revisit the predictions that I ran with a year ago when we had a similar discussion. And I'm pleased to report that it was very much a glass half full view of the world a year ago that we were advocating. And I think that did turn out to be the right view. albeit we didn't see the Delta strain coming along. So in terms of last year's 10 predictions, the first 3 around the global economy, I think we were right to say Asia outperforming, although Europe and the US have bridged that gap. Certainly under Biden, and I'm pleased that we've made the prediction of Biden winning that election in the States, but certainly under Biden, less trade tensions and more of a focus on technology and climate issues. How successful that's all been in COP26 in Glasgow, you could query, but at least Joe Biden turned up. I'm not sure Donald would have made the trip. He probably would have been at the golf course. But certainly the US pushing for more global cooperation on climate has been very important. In terms of the domestic predictions, also pleased to report they were around the money with the Aussie dollar trending higher. In fact, it got to 80 cents briefly earlier this year and held above the support levels that we targeted. Yes, there was a rise in debt levels, but our AAA credit rating intact, and RBA on hold. Still the same timeline, actually, that we expect today compared to a year ago. So a year ago, I said 2 years more of official cash rates at 0.1. Now we're saying 1 more year to go, so through to November of 2022. And growth really strong through the first half of 2021. And we'll talk about how the Delta strain impacted the second half. So they were on track. I think where I need to fess up that we lost a mark or two was really in the discussion around property. And certainly a year ago, I was very positive on regional property, but even talking about falls for resi property at all was way off the mark, and we were a little more confident than the rest of the market at the time. But in the end, 20% gains for property, which we'll have a look at. So I do need to take off a mark there, but it's self-assessed as a B+. So we'll see if we can upgrade that to an A with this evening's predictions. Okay, so that was last year. How are we tracking now, and where do we think we're all heading? And look, I do have to confess that with the slide here, there's a lot of information on the screen, so it might be a bit hard to read through this traffic light summary. And of course, very comfortable to share these slides so you can have a look at them in more detail in the comfort of your home office. But I think the main column to look at is the one on the right here, which is where we see these metrics landing in a year's time at the end of 2022. So the burgundy numbers show where we are. The numbers on the right in black are our forecasts. And this middle column is where we are right now. So I'll just run through the key measures and then we'll look at the slides in a bit more detail. But for employment, and we got the updated unemployment rate today for October, where we saw a rise in the unemployment rate to 5.2. No surprise, because that's reflecting the lockdown period for Victoria, for New South Wales, ACT. But we do expect by year-end unemployment back down to 4.9. And in fact, in a year's time, even a chance we can dip below 4%, which will be the lowest level that we've seen in, well, actually since the mid-1970s. So we are confident about employment growth to resume in the same way that it did last financial year. And speaking of last financial year, look at that growth rate that we saw as of June 30 of this year, 9.6% growth year on year. And that's what you'd hope for, given we did have the recession the year before, or the financial year before. As for growth in this quarter that we've just finished, Q3, it's going to be a quarterly contraction, but through the fourth quarter that we're in now, we should see demand returning fairly quickly. And then when we get to 2022, we're looking for around about 6% growth for the Australian economy. I'll look at confidence in a bit more detail in some of the slides. It does appear very strong and resilient at present. Certainly the property market is going gangbusters, and some of our predictions were for regional property to be very strong, but capital's a bit slower. Well, in the end, it looks like regionals will be up about 20% for the year and capital's 15%. But next year, we should definitely be expecting a much slower growth rate for residential property prices as RBA interest rate rises come closer. Certainly for trade, we've been running a strong trade surplus. In fact, it was a record in August, but we do see that a little bit lower next year. We'll have a look at some of those numbers and the cause of the challenges with trade, mainly around those geopolitical tensions with China, as well as, well, perhaps the AUKUS arrangement, not exactly helping our trade relationship with Europe either. The only red light in this slide in terms of predictions is around inflation. And I mentioned caution there for two reasons, both because inflation had been too low based on our central bank's target of 2 to 3%, and because I think there's a real risk that can overshoot and be above 3%. And certainly the Reserve Bank have been insistent that inflationary pressures will be temporary, but again, I think it's going to be really challenging to walk that line. So that would be really the most damaging scenario, where we see high levels of inflation, but growth doesn't come through. And that sort of stagflation scenario is the one to be most fearful for. But as it happens, we believe that growth can be strong. And that's one of the reasons, with a strong growth rate of 6% next year, that we think the Aussie dollar can move higher, penciling in back above 75 cents by the end of this year and back above 80 cents by next year. And as I mentioned before, the Reserve Bank cash rate on hold for around about 12 more months. We think the RBA will be hiking rates by November 2022, so 1 year to go. And in fact, the market is pricing in rate hikes well in advance of that by July of next year. So look, that's a fairly optimistic set of forecasts, certainly for growth and for employment. Why are we optimistic? Mainly around the employment growth that we expect to see. And you can see in this chart on the top right that we had 13 million Australians with a job going into the pandemic. That fell to 12.11 million, but when we then rose back above 13 as the recovery played out, just with the numbers out today, we're back down to 12.85 million jobs in aggregate, but that's the number that we do expect to be growing going into end of this year, and certainly growing aggressively through 2022. And the main reason we're optimistic about jobs growth is because job vacancies are at a record level, and job advertisements are at around about a 15-year high based on some of the surveys. And looking at the SEEK survey that came out yesterday, at a record level there. So businesses are employing, they're eyeing off the potential for growth through 2022. And in fact, there's a shortage of workers at the moment, a lot of shortage of skilled labour and accessing workers, which in a sense is a good problem to have. So that's our baseline forecasts. But that recovery scenario is what you would hope for, having had a once in a century pandemic. And interesting to look at the global trend of GDP, this blue line here. It's only a decade and a bit ago that we had supposedly a once in a century event with the GFC, and that certainly derailed the global economy pretty much for all of the last decade. Whereas this time, the shock from the pandemic is going to be slightly greater in GDP terms than the GFC, but we see a sharper recovery back to trend, because it was a deliberate shutting down of the economy and not part of a boom-bust cycle. So that's the global GDP trajectory that we see recovering over the next couple of years. And one of the key takeaways is we are here in the cycle now, about to go through this upswing. Similarly for Australia, we had the dip through the lockdowns when the pandemic first hit, 7% hit to GDP, all recovered by the end of the financial year. And now we're going through this second dip. In pink here is the latest RBA estimates. So it's not only about half as large a dip as we saw during last year's recession, but you can see the steepness of the recovery. And so that sort of double dip recession, this isn't going to be a recession, the latest dip, but it's certainly going to be a contraction in the third quarter. But the effectiveness of the support packages are going to be the main driver of the recovery, as well as the Reserve Bank keeping interest rates at record lows for another year. So just to quantify the size of those support packages, from the federal government, it was over $300 billion of direct economic support. Once you throw in state governments, it was probably close to $500 billion, so $500 billion. But interestingly, with this federal government support, so keep that number in mind, $310 billion, that was mainly funded by debt, and certainly not by tax increases. And so it was actually a 265 billion increase in government debt over that period, and that's going to keep accumulating. But at the same time, the Reserve Bank undertook quantitative easing, basically creating money at a keystroke to create the funds to buy that debt. And so there's been equally $310 billion worth of government debt that has been purchased by the Reserve Bank. So that's where the funding came from. And I'm pleased that it came from debt and not from taxes. But it is interesting, the interplay between the Reserve Bank and between the government's requirement to throw this money at the economy. And if you look at how that's flowed through to household balance sheets, it's been estimated that there's about $260 billion worth of deposits that are sitting in bank accounts waiting to be deployed, because we've all been, or a good portion of the country has been locked down and has been holding off on spending. So it seems a bit perverse to say this, but the average household has actually never been in better shape in terms of wealth as a ratio of disposable income, because property prices are sky high and because financial assets have done very well. Most superannuation funds putting on about 20% last financial year. And at the same time, liability levels, so debt levels, have actually fallen because interest rates are so low. So, you know, that's the average household. That's there's going to be a fair amount of variation across Australia, but that really shows the wealth effect that's been created from all this money that's been thrown at the economy. That, again, that's what you'd hope after a recession. Another piece of good news is the progress that we've been making on vaccination rates over the course of this year. And what we saw last year is that there was a strong correlation between managing the pandemic and economic recovery. You'd have to say the way we managed the vaccinations perhaps early on wasn't quite as effective for the first part of 2021, and no offence to Greg Hunt there, who'd want to be a politician at the moment, but it's been great to see the recovery and the pickup in vaccination rates over the course of this year. And so this chart on the left here shows the vaccination rates as of June 30, so halfway through this year, when Australia was only around about 8% fully vaccinated. And this is the whole of the population. Nowadays, we're more so talking about the adult population, where we're just ticked over 81% fully vaccinated. But you see how far behind the 8 ball we were halfway through the year, and now we've leapfrogged past the UK, the European Union, the US, and a number of countries in Asia, and we're really on a par with the most vaccinated countries in the world. And that statistic does matter, because it links back to how quickly we can reopen our state borders and how quickly we can reopen international borders. So without labouring the point, what we're seeing is that highly vaccinated countries, as they reopen their economies, sure, they're seeing an increase in case numbers because we're all interacting more closely again as we reopen, but we're not seeing an increase in hospitalisation rates or in mortality rates. And that quite simply links back to the effectiveness of the vaccines. And of course, the converse is true in low vaccination countries. Even if they're not having much success reopening, unfortunately, their mortality rate and their hospitalisation rates are very high indeed. And you can look at these numbers by region. I won't dwell on this, but you know, you can look at this for Western Europe, for North America, where you've got high levels of vaccination, and contrast that with other parts of the world where there's less vaccination, simply because those economies aren't necessarily in a position to afford them. But in the case of Australia, we have done very well on that front. And if I can just finalise this slide by making the point that there's a strong correlation between highly vaccinated economies and upgrades to GDP and growth outlooks, and therefore jobs creation. And so it's been good to see upgrades to Australia's GDP forecast for next year, mainly driven by those high vaccination rates. Okay, moving on to, perhaps before I come back to Australia, let's just check some of the essential data for key global economies. And in particular, I wanted to have a look at Europe, and I'm sure the audience would be interested in the outlook for the Greek economy. But interestingly, over the last couple of months, the concerns have really moved from being around the pandemic and being able to generate growth coming out of the pandemic to suddenly being concerns around inflation and supply chain disruptions. And you can see how that's trended just in this survey from McKinsey & Co. over the last couple of months. Suddenly, the primary concern is in fact around inflation and supply chain disruptions and labour shortages as well. And no surprise that that's happening given the United States, Canada, the UK and Europe all are seeing CPI rates at 4% plus. Some of the core measures of inflation are a little less aggressive, although even looking at the US last night, their core measure of inflation came in a lot higher than was expected. I think it was the highest since 1991. So we are seeing inflation rising pretty quickly. That comes back to the outcome that I mentioned before of demand rising very quickly, but supply not being able to keep up with it. And in the case of Europe, what we're seeing is elevated oil price, elevated price of gas, so energy prices very high, certainly a range of other commodities a lot higher than where they were 6 to 12 months ago, based on supply and shortages coinciding with a ramp up in demand, and at the same time delays in shipping and increases in shipping costs. So that's really the reason that inflation is in focus, and that's probably hit Europe as aggressively as anywhere going into the European winter. You can see how that's flowing through to the PPI, the producer price indices, and there you've got inflation up around 7 or 8% in Europe and in the United States. This really would be a major problem if it coincided with a fall in growth, but fortunately that's not the case at the moment, and we're seeing pretty strong growth through Europe, through also through North America. And I've got a chart here. I'm not sure how clear this is going to be, but you can again have a look at the slides, look at it in a bit more detail. This is the International Monetary Fund's current state of GDP growth, and dark green means 6% plus growth. And you can see US very strong growth there forecast, similarly in China and in parts of Asia. But in Europe, you've got 6% plus growth in a range of countries, and a slightly lighter shade of green shows 3 to 6% growth. So that's really what you need going through a period of higher inflation. And the forecast for next year is for European growth to be somewhere between around 4 and 5%, despite those supply chain bottlenecks and challenges. More specifically for the Greek economy, it's actually an even stronger position right now, where GDP growth running at 6.5%, which is the red line in this chart. And interestingly, not the inflationary pressures that we're seeing in Northern Europe. And so CPI there forecast to be fairly benign over the next couple of years. And that all links back to tourism rebounding really strongly, international travel picking up, as I'm sure you'd all be aware, and demand from some of the state support measures. So that's a quick look at overseas. Let's come back to Australia. And in the interest of time, I'll move through these couple of slides fairly quickly. But really the message around consumer and business sentiment is that it has been a V-shaped recovery, and that we expect that to accelerate through 2022. In fact, if you look at consumer sentiment, it was as low as it's almost ever been, rivaling the GFC last year. But suddenly we were up at almost a record high, certainly an 11-year high for consumer sentiment. We see that picking up or continuing that momentum as the economy completely reopens and as international borders and state borders reopen. And similarly for business confidence, we saw a record low for business confidence around about 16 or 17 months ago, and now here we are close to a record high. And there's a lot of regional divergence here. interestingly, New South Wales is about a month ahead of where Victoria is, and you can see how New South Wales business confidence is leading the way as they come out of their lockdowns. That's exactly what we're expecting. So across the other parts of Australia who didn't go through this second wave of lockdowns, the economy is performing very strongly, and it's either a V-shaped recovery or maybe a W if you count the double dip. Just to make sure I'm not being overconfident on all of this, I do need to balance that, businesses that are dependent on tourism, both domestic and international tourism, and dependent on international students, are needing to deal with the fact that we haven't reopened international borders yet. And so there's a chart that's neither a V or a W. That really is an L shape, isn't it, in terms of the number of international arrivals through the airports. And we were reaching as much as 1 million people per month coming to Australia, and that also fed through to the workforce. But at the moment, that's down to zero. So we do need more targeted fiscal support for those businesses that are dependent on international tourism and international travellers until we completely reopen. So that leads us into fiscal support. I mentioned before that the federal government's thrown about $310 billion at the economy, and close to $500 billion once you throw in the state government as well. Most of that's come from budget deficits. It was a record peacetime budget deficit from the federal government. So just to look at these numbers in a bit more detail, the deficit last financial year was $160 billion. This financial year, it's about $100 billion. But interestingly, we're not rising back above the line here, so we're not going back into budget surplus for the rest of the decade. So like governments all around the world, they're spending more than they're earning. And I think that's fine here in Australia. While we have a AAA credit rating, we can afford this debt as long as that borrowed money goes to productive purposes. And, it's scary to talk about $1 trillion worth of debt, but if you crunch the numbers, that still only comes in at a 41% debt to GDP ratio. So that's about half the level of where Europe is, around 80% debt to GDP. And you've got countries like the US who are up at 100%. So I'm absolutely fine with these debt levels. This is really leveraging Australia's AAA credit rating, and the fact that Standard & Poor's recently upgraded our outlook to stable from negative and reaffirmed our credit rating is testament to the affordability of this debt. But clearly at some stage, we're going to need to grow the economy so that the debt level is a smaller percentage of it. Probably the other comment I'd make around our debt levels is the interest burden as a percentage of GDP is actually falling over the next few years. So that speaks to how cheap the government debt has been, given how low interest rates are. I'll just quickly touch on the Reserve Bank's outlook here, and certainly central banks are all in on their quantitative easing and their bond purchases, and the official cash rate down at basically zero everywhere around the world. There's Europe down at minus 0.5%, but for Australia, we've been at 0.1% for some time. The market is actually fairly aggressively now expecting the Reserve Bank cash rate to be back at 1% by the end of next year. I'm in favour of this grey dotted line here. I think it'll be a slightly more cautious approach, and that's why we're forecasting a cash rate back up to 0.25% by the end of next year, and then not up to 1% till the year after that. Interestingly, though, the Reserve Bank are saying nothing to see here, no rate hikes until 2024 or thereabouts. But given the inflation numbers that we've just been talking about, that really does seem overly cautious. So I'll make the assertion that we'll follow this grey dotted line here. And perhaps more importantly, on the debt side, it's the long-term swap rates that are rising far more aggressively and quickly than just the cash rates. So there's a sort of a final opportunity, if you haven't done it already, to lock in debt before those term rates rise and before official rates start to rise in around about 12 months' time. Just on the property market, and I won't spend any great time on this because you'd all be across how strong property has been, but really interesting that the pandemic, far from halting property's long-term incline, has actually enhanced the boom, and that's for a few different reasons. But certainly Sydney, Canberra, and some of the smaller capital cities like Hobart and Adelaide have been leading the way. But if we look at the numbers overall, it really is remarkable. If we look at this end column here, the capital cities were up over 20% in value over the last 12 months, whereas regional property was up even more, close to 25% based on these CoreLogic numbers, and they're always good to have a look at on their website. But those growth rates are unsustainable. We're not going to be going at that pace for next year. We think it'll be closer to 4 or 5% growth through 2022, and you may even see a dip in property prices the year after. So the main messages there are regional property to outperform. But if we're thinking about the risks of the property boom, which has really been one of the main consequences of these ultra low interest rates, I think that the main problem there is around housing affordability. The fact that house prices are such a large multiple of income, but it's not a risk around, a property bubble, because household debt has actually been very stable over the last couple of years, again, because interest rates are so low. I'll keep moving on to conclusions now. Just quickly on equity prices. It's been an incredible recovery through 2021 after the 1 month decline we saw with the initial hit of the pandemic. Probably the main point I'd make here is that US has been leading the way, Japan and Europe pretty strong. Australia really has been lagging. We're putting on about 8.5% year on year in our stock market. But 4 or 5 years ago, the ASX 200 was at 6,000 and we've gone to 7,500 over the same period of time. The Nasdaq's gone to 16,000. So I think that really does show that contrast between a market which is heavily weighted to technology stocks, closely aligned to innovation and to demographic change and disruption. So that's where Australia needs to do a little bit better. And finally, on the Aussie dollar, look, if the Aussie was tracking commodity prices, we'd be up at closer to 90 cents. But this is where I think the the geopolitical overtones have really weighed on the Aussie dollar, the trade tensions with China. And again, thinking about the AUKUS arrangement, not sure that that's it's going to be as helpful as, say, the Quad Alliance with between Australia, Japan, India, and the US. But nevertheless, we do see some weakness in the US dollar next year, together with higher commodity prices next year, which is why we're calling for the Aussie to be higher. Okay, I'm almost out of time, so I'll just quickly move on. I've mentioned commodity prices to really our overall view for the Australian economy, which is GDP growth of at least 6% next year and employment growth, both going into the end of this year and through 2022. We see the unemployment rate just moving down to about 4.9% by the end of the year. It's currently at 5.2%, and then potentially down to below 4% next year, because we see employment growth as taking aggregate employment back to about 13.5 million. And again, driven by the high vaccination rates that I've talked about, driven by the record levels of job vacancies, elevated levels of job advertisements. So really strong demand for labour, and also the point I made earlier that household balance sheets are in really good shape on average, due to the money that's been thrown at the economy to rescue it from the deliberate shutdown that we needed to get through the pandemic. And so that's a combination of house prices, superannuation and where the markets are, and also retained earnings or retained savings, really accrued stimulus that hasn't been spent yet. And as a result, debt levels are quite manageable at a household level. So just to finalise that in words and to leave you with 10 predictions, and then looking forward to hearing some questions, and quite happy to have challenges on these predictions. But we do see the Chinese economy itself decelerating and really coming down from that high growth rate that we saw earlier this year, but managing a soft landing despite the stress that we're seeing in Chinese real estate markets. We do still think that COVID vaccines will be the key driver, and that will see some economies outperforming and others underperforming, and perhaps also speaks to the necessity to have more equitable distribution of vaccines. But on that front, the European Union is well placed, and that should help with tourism, especially for southern parts of Europe. Geopolitical tensions will continue to bubble away, but I think the US economy is also in for a reasonable period of growth. And part of that will link back to the technology explosion and the infrastructure binge that we're seeing, including the $1.2 trillion infrastructure package that Biden has just got through Congress. I've talked about stock markets. The last 5 predictions are for Australia's economy. I mentioned GDP growth well above trend. Regional economies, though, outperforming some of the capital cities. Nevertheless, the national unemployment rate to fall in all states and territories back down to a 4%. Aussie dollar up for the reasons that I've outlined, and property to remain in demand. But definitely RBA rate hikes will be increasingly on the mind of property investors, and that's going to impact the market through next financial year in particular. But overall, commodity prices to be, or commodities to be in demand, commodity prices to remain elevated, and that should help with export markets. So that's the outlook going into the new year. I think we're all going to welcome the end of 2021 with a great deal of enthusiasm. I may have said that a year ago when we were hoping 21 would be the real recovery, but it's all really need to be pushed back a year. But nevertheless, a cautious optimism about 2022. And whenever I get cautiously optimistic, I quickly put my disclaimer up on the screen. So I'll stop sharing my screen now, Paul, but thanks for the opportunity to share those slides. And again, very happy to send a copy to anyone who'd like a copy of the slides. But for the moment, I will wait in anticipation of any questions or comments around those forecasts. So thanks very much.
Thank you, David, for that great presentation. We do have a few questions. Just let me get to them. And they were here. Just a moment. We've got an interesting one that has come in through from Antonius. And Antonius asks the question, David, are there any indicators so far that see our relationship with China causing a dump of metropolitan Melbourne and New South Wales property from foreign investors? And are there any predictions with regards to this? Could it have an effect on prices?
Yeah, it's a very good question. And certainly during that period from about 2012 through to 2018, we saw strong investment from China, both from mainland China and from expats and so on, in Melbourne in particular, and through a range of capital cities. But I think what we began to see through 2019 and 2020 was some of that demand from overseas to actually shift more so from places like China to Singapore, some from Hong Kong as well. But the feedback I've been receiving is that the fall in demand from mainland China has not had a material impact on overall offshore demand. And as a result, we're not expecting that to be a key variable for property prices. We think a larger variable for property will simply be official interest rates, and also some of the lending standards that are coming through. The APRA a couple of months ago made a change to one of their rules around serviceability buffers. In other words, before a bank such as ours makes a loan, we need to crunch the numbers that the borrower could cope with rising interest rates. And that number was increased from modelling an increase of, I think, 2.5% to 3%. So they're the sort of factors that we think are more important for property than the bid from overseas. And in particular, as the question is exploring, it doesn't seem to be a fall in Chinese demand for Melbourne and Sydney property that is the main driver at the moment. Because there is demand from other countries, and Singapore seems to be the one that is filling that void to the extent that's been created by less investors coming from China.
Thank you, David. We've got a couple of questions in relation to the labour market. I've got one from Andonius and one from Vasilis. Let's start with Andonius first. And he raises a question. We've all suddenly, in the last couple of weeks, heard this this phrase, the Great Resignation. And Andonius asks, when do you see the skilled labour market stabilising, and do you feel that the Great Resignation will affect the skilled labour market?
Yeah, a really good couple of questions there. And yes, this phenomenon of higher job mobility, people more inclined to resign from what might have been a medium-term role to just saying, I'm going to try something different, maybe going out on their own, maybe just chancing their arm with another employer. It's not just here, it's around the world. And that's an interesting consequence of the pandemic. My view is that's going to add to labour demand. In other words, businesses are going to need to rehire. And, you know, obviously that's not an aggregate change. It just means more job mobility. But I think it will mean that employees rather than employers will be in the driver's seat there. So that's one of the reasons I think that'll flow through to wages growth. The question around skilled labour is a similar challenge, because until we have international borders reopened, we do have shortages in skilled labour, and we had them already even prior to the pandemic. If you think about infrastructure projects, which are going to be so important, that's great that governments are ploughing money into infrastructure, but you've got to have the workers to actually do the work. And Infrastructure Australia, in their recent report, cited the lack of skilled workers to be able to get some of those projects done. So you've got the short-term challenge of not having access to overseas workers to the extent that that was part of the solution. And then I think you've got the medium-term challenge of lifting general, making sure we've got the right skills for the future. And part of that is around things like infrastructure, but also jobs of the future are going to increasingly be, if we think about artificial intelligence and the role of technology disruptors, increasingly there's going to be higher education requirements to meet those needs. So we're going to have greater need for tertiary educated workers. A lot of the jobs of today simply are going to be done either by AI, or think about the role of driverless cars and driverless trucks and so on. That's going to be eating into a portion of the workforce. There'll be other jobs created, but they'll have different skill sets. So yeah, it's a real challenge both to cope with the short-term need and also education reform, skills investment to make sure we've got the workforce of tomorrow. So nothing easy about all of that. Again, that's one of the reasons that I think wages growth will be strong. That's one of the reasons I think demand for labour will be strong. But it does mean that we both need to reopen international borders more quickly for the short-term need, and it also, I think, needs federal government, and we'll see who wins the election, which will probably happen early next year, what the commitment from whoever wins that election, what their commitment is to education reform, skills reform, to make sure we've got the workforce of tomorrow, lifting those skill levels.
Thank you, David. We've got an interesting question on local demand, and I encourage people listening in to post your questions. This is from Nick, and thank you, Nick, for raising this one. He says, David, were you surprised that local demand held up when our population was stagnant and migration and student arrivals shrank significantly over the last 2 years?
Yeah, so as a general comment, I would say that population growth is healthy for the economy. And if you look at the recent government's intergenerational report, they point out the challenges that Australia is going to have because we've got slowing population growth. And, you know, the modelling in that report, I think, talks about 235,000 increase in net migration per year, which is where we were prior to the pandemic. But yes, to the point of the question, suddenly during the pandemic, we didn't have any population growth and nothing coming from overseas. So was I surprised about the rebound in demand given that? No, based on the fiscal support and the monetary policy support. So I think that's where the demand came from, the fact that governments, both federal and state, were very quick to support the economy, to support households, to support businesses, but that isn't sustainable. And so we do need to get back to a situation of natural population growth and immigration to support skilled labour and to drive more sustainable growth. And that's the short answer. The long answer is in the government's intergenerational report, which is a fascinating 220 pages of explaining it. But what we need to lift living standards over the decades is an increase in productivity. And productivity has got a number of drivers, either, and if you can't have population growth, then you're going to need to see different forms of productivity enhancement to lift living standards. And some of that will come through technology and innovation. Some of that will be through the ways we work. But best if we complement that productivity growth with population growth as well. We can't just rely on fiscal support forever. And I think the government's done a great job with its fiscal support, but now we need to see productivity growth to get a more sustainable growth.
Thank you, David. I've got one here from Nick who says, David, with the property market basically driven by investors rather than first home buyers, doesn't this support the case for curbing negative gearing to assist home affordability? I know it's something that was discussed at the last election.
Yeah, it's another good question. And look, actually, interestingly, until about 3 months ago, it was mainly owner-occupier demand and first homeowner demand that was driving the market, which was great to see. But yes, over the last 3 or 4 months, it's been the investor side that's really taken off. And I think that's because investors were sitting out and just waiting to see a more certain future. And now they've got a slightly more certain future, albeit maybe only for the next 18 months. So does that mean that we should be reviewing the tax incentives, negative gearing? Yes, but that was one of the key platforms in the last election, and voters actually shied away from that. Now, I think perhaps that's because without going into the politics of it too much, there was probably a bit too much change that was proposed at once, and it needs to, I think, be a slower process. But absolutely, there needs to be a focus on housing affordability and how we help first homeowners into the market, especially given property prices got up 20% in the last year. So I definitely support, along with tax reform, education reform, super reform. Yes, part of that is tax reform that links back to property. But my overall comment there, to perhaps push back on it purely being around tax, is I think it's the supply of housing which it can be part of the solution, not just negative gearing. With increased supply of housing, then we can address housing affordability without necessarily completely winding back the negative gearing and some of those other tax breaks.
Thank you, David. I think in the let's be conscious of the time. We'll take 2 more questions. This is an interesting question, and thanks, Costa, for asking this question. it's a problem that many households face with regards to fuel prices. And Costas asks, how are you seeing fuel prices affecting inflation in Australia? And a supplementary comment, is there a need for faster electrification of the Australian vehicle fleet to cushion any such future hikes? Great question, Costa.
Yeah, that is an excellent question. And definitely in the last CPI report, where the inflation rate, headline inflation was 3%, core inflation came in at 2.1. Definitely petrol prices were a large part of that, of the headline, but the core number, it's sort of stripped out of it. The core inflation tries to get rid of some of those more volatile numbers. But ultimately, higher oil prices, higher gas prices feed through to everything. And that definitely was part of the inflation. That is part of the inflation problem we have. And that's one of the reasons that I'm concerned that inflation will overshoot the mark. As for electric vehicles being part of the solution, absolutely. And they're part of the climate solution. So there's environmental reasons to go harder on electric vehicles, where Australia's had a much lower take up than other countries. Part of that has been because, arguably, without going into the politics of it, and this is both state and federal politics, arguably there has not been enough incentives for those makers of electric cars to come to Australia. So on a number of fronts, yes, electric vehicles are going to play a huge role both in addressing environmental problems and in having a more sustainable future, including energy costs. But there do need to be technology advancements, e.g. battery storage and so on, to get that right. So it's going to take time. And that's one of the parts that I agree with the PM. I don't agree with everything he says on this, but he is right in saying that technology will be part of that solution.
And certain countries, such as Norway, have taken a completely different stance on electrification.
Exactly.
I think our last question here from Kiki, and a very interesting question on swap rates, and one of your specialties there, David. Can you elaborate further on the swap rates you mentioned earlier and the impact on home loan interest rates?
Yeah. Again, another excellent. They've all been great questions, and that's a good one to finish off with. So, look, if you look at the 3-year swap rate, and that's published, you can look it up if you need to have a look. The 3-year rate was 0.4 3 months ago, and now it's 1.4, or it got to 1.4. I think it's at 1.25 now. So it's gone up about 1%. And when that goes up, basically the cost of providing a 3-year fixed home loan goes up by 1%. So it's pretty remarkable that home loan rates haven't gone up much yet. But I'd look at those swap rates and say it's somewhat inevitable that they will. And I think some banks have done that already. And I can't see a situation where they all won't in the next month or two, because if the swap rate goes up, which is basically where that's a traded price for 3-year money, then that has to flow through to how you can offer fixed rate loans. So they've got up 1% in about 3 months, and you never know exactly where they're going to go in the next 3 months, but typically that would flow through to fixed home loans, fixed business loans, and so on. And so, yes, the opportunity to lock in your loan, I'm afraid that opportunity is quickly receding.
David, I'd like to thank you on behalf of all of us, including Delphi Bank and our friends at the Greek Community of Melbourne, for that thorough presentation. We certainly at Delphi Bank enjoy bringing the community these updates, and we're very lucky to have David to present them. So on behalf of all of us, I'd like to sincerely thank the Greek Community of Melbourne of hosting us, but also to congratulate them on this series of lectures that they bring to the community. They've really done a wonderful job in opening up the community to a lot of the members that may not have availed themselves of the community services in the past. So congratulations, Greek community, on what you're doing. President Bill Papastergiadis and our friend Nick Dallas, who does a wonderful job, and Costa on the technical side of things. So on behalf of all of us, thank you very much, and we hope to see you again next time.